It's Friday afternoon in Sydney, Australia, and that means it's time for Friday Beers with Marc and Stuart. I'm Stuart Roberts.
I'm Marc Hennis.
And we're the founders of Pitt Street Research, Australia's leading provider of issuer-sponsored equity research, focused on small and mid-cap companies publicly traded on the Australian Securities Exchange. Marc, often when you and I have lunch, we talk about people with crazy worldviews, like people with strange religious views, for example.
Yeah, we do.
So, anyway, I've found a new religious minority group to poke fun at.
Right.
It's called People Who Believe in the Efficient Market Hypothesis.
Are there still people that believe in that?
Can you believe it?
No.
There's still a few people out there who haven't got...
Quickly explain, what is it?
Yeah, so the efficient market hypothesis is the belief, and there are various, like any good church, there are various denominations. It's the belief that the market quickly factors in all the available information to pricing a share price. Now, Marc, disprove the religion of the efficient market hypothesis.
Yeah, well, that's pretty easy, actually. So there's a company called Revasum, listed on the ASX last year.
Right.
They make computer equipment to manufacture semiconductor chips. So
Right.
computer chips, basically.
And it's in California, you visited them earlier this year.
Yeah.
Right. Your health, sir.
Cheers. And essentially, the products they've been developing over the last 2 years are geared towards the manufacturing of computer chips based on a substrate called silicon carbide. I won't get too technical, but
Right.
what you need to know is that silicon carbide-based chips are being used in electric vehicles, for instance, for
Right.
power management.
Right. It's just that they can cope with more heat than the typical substrate, right?
They're a lot more efficient in handling that.
Yes.
Well, there's a bunch of stuff. We did a big report on that actually in 2 months ago,
Yes,
I think.
yes.
Have a read. It's on the website. But really, what it's geared towards is the take-up of silicon carbide in the next couple of years. Now, one of the biggest players, maybe the biggest players in silicon carbide manufacturing is Cree, company out of the US.
Right.
They a couple of months ago announced a big capex plan,
Yep.
$1 billion in expansion of their facilities using equipment, including the equipment that Revasum makes.
So this is an 800-pound gorilla in the semiconductor space, right?
It's a huge one.
Right.
Yeah. So in itself, it's not the biggest one, but specifically in this niche.
Right. In that silicon carbide niche that we were speaking of.
Yeah.
Okay.
It's one of the biggest ones. Now, company Revasum announced in their update for the last quarter this week that they signed Cree as a client in a multi-year deal.
Right.
Now, they didn't disclose any numbers, but in my view, this will lead to several tens of millions of dollars in revenues over the next couple of years.
Right.
Anyway, guess what the market did after the announcement?
Okay. Well, it should have gone up if you factor in all the known knowns, but it went down, right?
Well, it went down just a little bit. It stayed where it was
Right.
after granted a revenue warning a little while ago, but that's just a semiconductor cycle, sort of showing its rearing its ugly head. But based on this news, they signed one of the biggest clients they could possibly get in this space.
Right.
Share price does absolutely nothing.
Right.
And looking out, so just 6 months or a year from now, when the cycle indeed has turned,
Yes.
and you see this uptick coming through.
And we're in the early stages of that uptick you're speaking of, right? Or at least it's on the horizon.
Yeah, so the latest data sort of points at Q4 of 2019 for that pickup. Long story short, in my view, the Revasum sort of announcement sort of disproves the efficient market, basically.
Right.
Because in my sort of humble opinion, investors are not getting it. Even though the news is out there, market is doing absolutely nothing.
And we've published a pretty good research report that can allow investors to get familiar with this story, right?
That will explain sort of what it is, what they do, where they sit, and what the opportunity is, basically.
Okay. So do yourself a favour, download that report. These guys have bagged the elephant, basically. So, great story.
Yeah.
Now, on other news, we had Grace Lin, CEO of Retech, came to visit us early this week.
Yeah, we did an interview with Grace just on Retech, e-learning company out of China, expanding into Australia as one of the territories, and one of the really big drivers for them will be remote English courses. So you'll have English teachers in Australia teaching kids in China, through a live link and large screens, and it's very different from the traditional e-learning.
Right.
So have a look at that interview. It's on our website as well.
And I mean, if you've ever been to China and you look a bit Western, everyone wants to come down and practice their English with you in the town square. So
or take your picture.
So the market opportunity for what Grace and her team is working on is huge.
Absolutely.
Okay, so take a look at that report. And for our Chinese viewers, as we shared a couple of weeks ago, we've actually made a version of that report in simplified Chinese, perhaps to make it easy for those folks. So
and that's
two languages
available on the website as well.
Right.
Yeah. So still, this week we've got a new new advisor on our advisory board. So Pitt Street Research is growing.
Yes.
And we need more sort of people with a solid background in financial services to advise us, basically.
Right.
So we've got a new advisor.
Okay. Well, let's put his picture up there on the screen.
Yeah, here he is.
Okay.
Yeah, so that's Conan the Contrarian.
Right.
So as our chief contrarian officer, you've been consulting with Conan.
Yes.
What's ugly mutts has he dragged out of the pond this time?
Yeah, so there's nothing I love more than finding a stock that people absolutely hate with a passion that you just know has reached the maximum level of hatred where it could turn around. Now, this week's genuinely ugly mutt is Costa Group.
Right.
ASX code CGC. Costa is I think a success story that's coming. It's the leading producer of fruit and vegetables in Australia.
Right.
And
that explains the berries.
So I bought in, that's Driscoll's berries. If you go into the supermarket and get Driscoll's berries, these guys have a hammerlock on supply of berries into all the major outlets. They also do late-stage citrus. They do avocados, tomatoes, and mushrooms as well.
Oh, mushrooms.
Mushrooms.
Oh. Tell me about those.
Investors feel like they've been treated like mushrooms for this one over the last 12 months because they've had a succession of profit warnings. There's been 4 in the last 12 months. Now, there's a simple reason for that. There's a drought on. For those of you who
I know all about droughts.
Right.
I've been on a drought in between relationships. Lasted a lot longer than I thought.
Well, hopefully it didn't last as long as this one's been going on. So Australia's going through one of the worst droughts in living memory. Whether it's climate change or whether it's just the fact that it's a warm climate that occasionally is susceptible to drought, this one's really bad. So it's affecting the supply-demand relationships as well as the quality of all sorts of fruit and vegetables, of which and that's got to impact Costa. Now these guys are still profitable at this point, but there's a problem. All of the major capital expenditure of the last several years since they went public in 2015 was debt funded, and there's about $400 million worth of expansions. They're in danger at this lower level of business, drought-induced, at breaching some of their banking covenants. So they've been forced to do a deeply discounted rights issue.
Oh, quanta costa?
And the Costa of that one is $2.20.
Now, that's a big discount.
Now, that's interesting to me because this company floated on the ASX in 2015 at $2.25. And then they went all the way to $9. And if you look at the long-term chart, it's a perfect V at that point. It's back to where it started. Now, I'm saying it's worth a punt at this price because everyone hates it. It's not unreasonable that it could start to rain on the East Coast sometime soon and give a boost to their business. This company's been so gutsy they've actually put that into their forecast.
Right.
They think pre-Sagara, the unusual accounting you have for agricultural stocks here, they can jump their impact from 98 million is their forecast for calendar 19. They think they can go 150 million in 2020.
They're now the weatherman, basically, forecasting rain.
Right. Okay.
That would be my biggest issue with this sort of stuff.
Yeah.
Where a drought can last a lot longer than you think. Granted, it's been a while, one of the longest ones on history, I guess.
Yep.
But it might go on for another year.
Right.
So that's a bit of the challenge then.
Yeah, that's right. That's right. So it is a hairy-chested punt. And this is an ugly mutt. There's no question about that. But I think risk reward. Even Ben Graham would go for this one. Given that it's priced at only 7 times EBITDA.
All right.
You've just heard my contrarian idea of the day. Here's a little more respectable idea. Take a look at Kogan.com. This is the Amazon of the Southern Hemisphere.
Right.
The stock is about $6 now. I think it's going to 10 because they're growing.
I think it's going to 4.
Okay.
I'll tell you why.
All right,
we have very bad experience with Kogan delivering our TV.
Okay.
I'll save you the whole story,
okay.
But basically we've been trying to get our TV replaced for 2 months now because they delivered us the wrong TV.
Right.
And it's just a nightmare. We didn't have a box. We need to get a new box.
Yep.
The pickup guys, the courier has been in twice yet already. No box. So the whole sort of aftermarket experience was really bad. So
all right.
I'd say
potentially growing pains at Kogan. Ruslan, you need to lift or your stock's not going to $10.
Step it up. So we've been talking about Costa and Kogan for a while, long time, but maybe just quickly on hawkish. That's really good.
Yeah, so we were in Melbourne last week, and so I tested some of the beers that you can get down there. This one, I reckon, is the second best beer I've ever drunk since I started drinking craft beer. This would be the sort of beer you'd put in your girlfriend's fridge. It's so good.
Can I have it at home as well?
Absolutely, wherever good beer is drunk. So it's Hawker's West Coast IPA, 7.2% alcohol, so it's pretty strong there. But as a West Coast IPA, they bitter it nicely, but don't blast it away so that you've got no taste buds left at the end. The only beer that is as good as this is Bent Spoke from Canberra. I mean, it's pretty easy drinking, right?
Yeah, it's nice.
Right. I imagine that there's more where this came from. If the Hawkers folks are as good as brewing this in suburban Melbourne somewhere, I don't know if you can visit the brew pub, but if we had some time, I'm heading out there to Reservoir to take a look at this. It's very good.
Yeah, absolutely. On that note, we'll wrap it up. And,
good luck, investors and believers in the efficient market hypothesis. See the light. You've believed the wrong faith. Have a good week.
I'll drink to that.